Welcome to Yahoo Finance's flagship show, The Morning Brief. I'm Julie Hyman. Let's get to the three things you need to know today. First up, U.S. stock futures falling this morning as traders digest trade headlines and the latest jobs report. Non-farm payrolls for July coming in at 73,000. That's below the estimate from economists of 104,000. Also in focus, a major downward revision to June and May jobs. June cut from 147,000 to just 14,000. Plus, President Trump unveiling a new slate of new tariffs in his effort to reshape global trade. The baseline rates for many trading partners will remain unchanged at 10% from the duties that Trump imposed in April. But Canada will face a 35% tariff, Switzerland 39%. The moves mark a sharp increase in levies, which are roughly 6 times higher than a year ago. Trump is expected to unveil separate tariffs on imports of pharmaceuticals, semiconductors, critical minerals, and other key industrial products in the coming weeks. And a mixed picture for big tech earnings. Amazon slumping today after issuing a disappointing profit forecast that has investors searching for signs that its AI investments are paying off. Meanwhile, Apple rising after posting its fastest revenue growth in more than 3 years, demand picking up for the iPhone and products in China. Tariffs ultimately costing the company $800 million for the prior quarter. Let's get a check-in on stock futures. Now, all of those cross currents included here and incorporated into the trade this morning. We had been seeing actually futures indicate an even lower open before we got the jobs report. How is that affecting things? Well, we are seeing a change in the probability being priced in that the Fed may cut rates in September and beyond. We're going to talk much more about that. But for right now, we've got the Nasdaq indicating a drop of more than 1% at the open, dragged down by Amazon. The S&P down about 1%, and then the Dow also taking a hit of about 0.9%. Those are the indications for the opening bell. Let's dig into those top stories of the day. Now, the July jobs report coming in below expectations. That has stocks pulling back, along with renewed trade war fears after President Trump signed an executive order officially hitting dozens of countries with new tariff rates. Plus, Amazon and Apple wrapping up a big week for tech earnings. Joining me now, senior reporter Ali Canal, senior reporter Brooke DePalma live at the Nasdaq, and tech editor Dan Halley. Deep breath, guys. Obviously, there's a lot going on. Ali, let's start with you for a closer look at that July jobs report, but not just July, those big revisions.
Yeah, very weird report here, right, Julie? I mean, huge revisions for May and June. We did see jobs for the month of July come in below 100,000. That was a threshold for many economists out there. And then we saw a slight tick in the unemployment rate for 4.2%. Now, I will say 4.2% is still historically pretty low, but we know that's a number that Jerome Powell has been increasingly focused on. It's all been about the unemployment rate. And you were just talking about those September rate cut odds. Heading into this report, there was a lot less conviction out there from markets that we would be seeing that cut in September, especially after Jerome Powell was a little more hawkish in that post-decision press conference on Wednesday. But now we're seeing those odds skyrocket. We are firmly above 60,000, heading closer to a 70% chance that traders anticipate a September cut. Across the board on Wall Street, we have a variety of opinions. Morgan Stanley, Ed Yardeni from Yardeni Research, they believe that we will not see any rate cut this year. JP Morgan is anticipating a December rate cut, but Michael Feroli, the economist there, he did say that if we see bad job reports, that could push up the odds of a September cut. And to that point, heading into this, we have seen softness in the jobs market. JOLTS data coming in below expectation. The quits rate, which is a sign of confidence among workers, that ticked lower, what we saw in these results this week. And then across the board on a sector basis, we had large gains in healthcare. Federal employment jobs continue to decline. But really, all the other industries are sort of waffling in the middle there. Pretty much little change as we see this low fire, low hire environment. So all things that the Fed is considering, obviously the two dissents, Michelle Bowman, Christopher Waller, they've been preaching that the job market is softening and that you need a rate cut in order to preserve that side of the Fed's dual mandate. But again, unemployment is still solid. 4.2%. Interesting to see bond yields. Obviously, there's a lot of buying there, and we've been talking a lot about bonds over the past few months, especially after we saw long-term yields spike in the wake of that tariff announcement. But now we're seeing aggressive buying there. Dollar seems to be doing solid, but we are trading in the red across the board for futures.
Yeah, and Brooke, I'm just looking at some commentary from Jefferies' chief U.S. economist, Tom Simons, and he says, surely Chair Powell wishes he had these numbers 48 hours ago. He says he could have been able to deliver a more dovish message easier. It would have been easier to deliver with confidence with these numbers in sight. What kind of commentary are you seeing on what's going on here?
Julie, hindsight's 2020, isn't it? I mean, when you think about what exactly we were heading into, we were looking for that 4.2 number. And heading into this report, Bank of America economist saying there that unemployment rate will be something to gauge the market by. She had expected at the time that markets would take this as a signal of a balanced labor market, despite the payroll moderation. But everyone really focusing in on that revision from back in June, despite the fact that unemployment only ticked up from 4.1% to 4.2%. And that's the sort of color that we're hearing on the street this morning, is that this was, heading into this was supposed to be a report where we were yet again going to see another signal that everything from the tariff impact hasn't fully been baked in yet as these have gone into effect. And now what we're hearing is really this change in rhetoric. As you can see, stock futures, if you look at, the global exchanges here, the Dow, the way that we reacted is that as soon as we got this report, you see a knee-jerk reaction among investors. The Dow moving lower, now down about 0.8%. And then this sort of, understatement that we had that 4.2 unemployment rate that sort of was a knee-jerk reaction back to the bit of the upside. And so certainly it'll be something to watch.
Yeah, exactly. The other thing is the feedback loop from trade to jobs and back again. I'm looking at a note from strategist Peter Bookvar this morning. He says, bottom line, let's be honest here, volatile and costly trade policy has stalled decision-making on the part of companies, with many hitting the pause button on hiring. So he at least is drawing that line from trade to jobs. Allie, we talked to Veronica Clark, economist at Citi, in the last hour, and I said, why is the market so surprised by these trade headlines? And she said, really, it seems as though people thought that the whole taco thing would go through, that Trump wouldn't necessarily go through with these tariffs.
Yeah, and to your point of uncertainty, we've been hearing that across the board from these companies this earnings season. It's been really difficult to make a lot of changes. Amazon just talked about that last night on the call. Now, it does seem like tariffs, if these changes go through, as President Trump has indicated, Capital Economics estimating that the effective tariff rate will now be closer to 18%. Prior to the latest announcement, we were hovering at around 15%. Either way, though, we're significantly above where we were last year. And Federal Reserve Chair Jerome Powell talked about this. We've been seeing in a lot of the sentiment and survey data that when it comes to core goods, certain products like furniture, footwear, apparel, we are seeing prices start to tick up. And this is just early innings here when we look at tariffs and the impact that they could have on the economy and the U.S. consumer. So this resiliency of the consumer that's really propped up this economy, but that's still a big TBD, especially at a time when we don't really know where these tariffs are going to land. There is commentary out there on Wall Street that economists say we will see some more negotiation there, but we just don't know at this point.
We do not. Okay, so here's what we do know. We know what Apple earned last quarter, and we know what Amazon earned last quarter. Dan, I want to go to you on this. Let's talk Amazon first, because this is the one that is really moving more this morning and is sort of one of these things is not like the other situation relative to its cloud peers.
Yeah, getting slapped around this morning. My goodness. The big deal here for Amazon was obviously the AWS number and then the outlook for operating income. So they beat on the top and bottom line. It seemed like a good quarter. They barely squeaked by beating the street's estimate on AWS, though. And then their operating income for the current quarter came in lower than the midway point. So the big takeaway is they're not really making the money that Microsoft and Google are in their cloud business. Now, Andy Jassy would point out that they're a markedly larger business than Google. Absolutely fair and absolutely true that they're larger than Microsoft. totally for sure, but you have to look at it from the totality of Amazon itself. And so, when it comes to the AWS AI story, it just doesn't seem to be kind of working its way out at this point, as well as something like a Google or a Microsoft. Now, you could point to the fact that Microsoft has OpenAI and Microsoft has its own models that it's working on. Google has Gemini, obviously, and they have investments with Anthropic, but so does Amazon. They have investments with Anthropic. They have their own models. They bring in all the models that are available. So at this point, it just seems to be that the spending isn't lining up with the income just yet. Now, if this was, I don't know, a few quarters ago, people might have just said, okay, fine, we get it. You're still building out. But I think because of what happened with Microsoft, because of what happened with Google, because they started to take off this quarter, now people are looking at Amazon and saying, how come you guys aren't in lockstep? So it could just be that, people were jazzed about Amazon, Google and Microsoft. They see Amazon and they say, well, come on, guys, pick it up.
Yeah, it feels that way, right? Especially on a relative basis. And speaking of relative basis, Apple, I guess relative to pretty lousy expectations, did okay.
Yeah, I mean, look, they did fantastic as far as the quarter goes. Knocked it out of the park when it came to iPhone revenue. Beat expectations on that as well as on the top and bottom line. The problem, though, seemed to be the situation with AI. Right, that's going to be the conversation going forward. Wall Street wants to see Apple with a definitive AI strategy. They don't have it quite yet lined up, right? They're working behind the scenes. They say that Tim Cook said that they're investing heavily in R&D for AI. They're open to making acquisitions, but they didn't give us a full indication of when that's going to happen quite yet. They said that the more advanced Siri is coming in 2026. It was supposed to be coming this year. Obviously, there was delays. So it really is that kind of story of, show me what you've got going on as far as AI goes. And I've said this before. This is wholly a Wall Street thing at this point, where it's, investors, analysts, they want to know Apple is going to be a big part of the AI story. The consumer, I don't think they really care. I'll be honest with you. I think at this point, it's AI is going to be a part of products, but not a product in and of itself when it comes to consumers, unless it's an app like ChatGPT.
Yeah, I love this point that you've been making recently, and it's something I'm going to ask Tom Forte about, an analyst who covers Apple, who we're talking to at the top of the next hour, Dan. So stay tuned for that. Allie, Brooke, Dan, thanks for being here. Appreciate it. Let's check in on shares of Figma this morning. The stock is up 16% after surging 250% in its Thursday debut on the New York Stock Exchange. The cloud-based design software company is hailed for its real-time collaboration features, allowing multiple designers to work on projects at the same time. Clients include Amazon, Microsoft, JP Morgan. Here with more details is the host of Market Sunrise, Ramzan Karmali. Ramzan, good to see you. So this was a real hot one here in the U.S.
I think it's fair to say this was a successful IPO, and it's likely to trigger a flurry of deals for venture capital-backed startups that have had to wait years to list, to be honest. You mentioned Figma's biggest customers there, but there are many more. In fact, Figma boasts as a result of its AI tools that one of its customers that we know quite well here on Yahoo Finance, Vanguard, the investment management firm, it could design 50% faster because of Figma. And even the European car giant Volkswagen is another big customer of theirs as well. And in the IPO listing, they mentioned Netflix and Duolingo as well as being customers too. But remember, one key reason that Figma have gone public is down to the fact that there was a collapsed deal between itself and Adobe. That deal was originally announced back in September 2022, but fell apart the next year. And it would have seen Adobe acquire Figma for a combination of cash and stock that would have valued the firm at roughly $20 billion. Now, on yesterday's closing price, Figma would have a valuation of $68 billion. And now, interestingly, it was actually the regulator here in the UK that objected to that deal. The Competition and Markets Authority said that it was worried that the merger could lessen competition in the markets for things like product design, image editing, and illustration software. So the US IPO market, though, it's improved over the second quarter. According to S&P Global, there have been 59 offerings. They've raised about $15 billion. That's up from 45 offerings that raised $11.2 billion in Q1. But another major centre is London, and the story here is not so bright. Fundraising from new listings has actually fallen to a 30-year low. The London Stock Exchange Group revealed better than expected earnings yesterday, but the markets didn't like what they heard. Shares fell pretty sharply, and they're actually carrying on falling sharply today as well. I actually did catch up with the boss of LSEG, as it's better known, David Schwimmer, and he's really insistent. He says that London can still compete with New York when it comes to new listings.
Some of the challenges of going to New York, a lot of companies, if they're not above a certain size and have I'll say a particularly hot story, they get lost in the U.S. capital markets in New York. They don't get the right attention from investors, from research analysts. And so we've had conversations with companies like that who are actually looking for an environment where they will get the appropriate attention from investors. So is it a great market for some companies? Absolutely. But there are many companies where it makes much more sense to be listed and trading in the UK.
So is London better than New York?
I would say for certain companies, absolutely.
So he insists London is better than New York. One thing he also insisted was that London still remains the #1 destination for business in Europe. But, you know, he faces big challenges. He says there are IPOs coming. He says watch out next week for a European listed company to launch here in London as well. But, you know, the competition is pretty hard. And it's not just New York. There's also Hong Kong as well. That's had a pretty decent sort of last couple of months as well. But, you know, the competition for listing is very hot at the moment. And New York at the moment seems to be winning that battle.
Ramzan, is London better than New York?
Of course I've got to say yes.
Of course you are. And I'm going to say New York's better than London.
And even the weather's nice today.
It's better here. It's better here than it has been, for sure. Ramzan, thank you so much. Appreciate it. Coming up, we're going to count you down to the opening bell on Wall Street. Don't go anywhere. You're watching Morning Brief on Yahoo Finance. Now time for some of today's trending tickers. We are watching Coinbase, energy stocks, and Moderna. First up, Coinbase reporting a drop in adjusted profit. It was hit by weaker trading activity during the second quarter. Retail crypto trading volumes were sluggish during the period thanks to muted investor appetite, even as crypto prices surged. Coinbase says it's focused on the tokenization of traditional financial assets to drive its next leg of growth. It's aiming to become an everything exchange. Next up, Exxon and Chevron both reporting steep declines in profit during the second quarter as lower oil prices weighed on the oil giants. Still, both companies did manage to top revenue expectations thanks to record oil production. Chevron recently completed its acquisition of Hess after ExxonMobil lost its legal challenge to that deal. ExxonMobil CEO Darren Woods, meantime, says the company is keeping an eye out for more acquisition opportunities. And finally, Moderna lowering the high end of its revenue outlook for the year, citing a delay in shipments to the UK. The results coming amid a cost-cutting push of the drug maker to offset weaker COVID vaccine sales. Those efforts appeared to take hold during the quarter. Moderna's second quarter loss was narrower than anticipated. Earlier this week, the company announced plans to cut roughly 10% of its workforce. You can scan the QR code below to track the best and worst performing stocks with Yahoo Finance's trending tickers page. Stocks are poised to open lower as investors digest President Trump's tariff deadline and this morning's weaker than expected jobs report. My next guest says with valuations where they are right now, that a negative surprise could trigger an outsized market reaction. Let's bring in Brian Jacobson, Annex Wealth Management Chief Economist and Strategist. Brian, it's good to see you. A lot to digest this morning. What do you make of this weaker than expected jobs report?
Yeah, I think this is one of those reports where if the Fed, if they knew then what they know now, they may have actually cut rates. If you consider the back month revisions, a total of 258,000. I mean, effectively, Waller and Bowman, the ones who dissented from the decision to stay on pause, I think they're being vindicated here, is that there were signs of weakness. They anticipated that we would see these seasonal adjustments, back month revisions, and that's why they were warning that the labor market isn't as strong as what it looks. And so I think that this is maybe one of those situations where history is going to repeat. Last year, in July, the Fed decided to stay on hold, and then they got some bad data. They decided to do that catch-up cut at their next meeting in September. Seems like maybe the exact same thing might play out this year.
And yet, Brian, at the same time, we got those tariff rates announced overnight and confirmed that they're going to in effect on August 7th. So yes, maybe the labor market is weaker than anticipated, but what's going to be on the other side of the dual mandate? What's going to happen with inflation as a result of that?
True. And that's the big question. question is in terms of the effects of tariffs on inflation. And inflation induced by tariffs could be, just as Waller has said, just a one-time increase in the price level. So it's a temporary increase in inflation. And then as long as the tariffs don't keep going up, and as long as people don't expect prices to go up, you really shouldn't see persistent inflation. And that's what Powell, I think, is really concerned about, are the inflation expectations. He knows that mechanically that tariffs should only result in a one-time increase in the price level. But he's just not confident that the psychology would actually support what the theory says.
Is Waller back again sort of as a front runner to take the place of Jay Powell as a result of all of this?
I think that this, his statement coming out just before the jobs report, him and Bowman, it probably does put him at the front of the line in terms of who should be at the helm of the Fed. There are other names that are out there, of course, with Hassett and Kevin Warsh, but given that Waller is already on the Board of Governors and he's kind of being proved right, I think that this does tilt the scales in his favor.
Brian, on the flip side, is the job weakness because of the tariffs? Are companies reluctant to hire because of the tariff uncertainty and even the tariff rates being higher than anticipated?
I'm sure I'll get flamed for this, but yes, I mean, it is due to tariffs. It's due to high rates. They're contributing factors across the board. And I think that when you look at what CEOs are saying and what we're hearing from the earnings reports, they did decide to go on pause during the first quarter and even into the second quarter because of tariffs. Now, will they, with the tax incentives from the One Big Beautiful Bill, will they now pick up the pace of hiring, especially in terms of, say, with construction spending, trying to invest in the United States? Maybe we will see that reacceleration. But I think that if we had to attribute the job slowdown to, is it tariffs or high rates, you really have to say it's both, but primarily it's been due to tariffs.
So, Brian, how does this all inform then strategically what someone should do in this market? And are we seeing this volatility that we're seeing this morning on the back of record after record after record? Is that what we're in for now for a little while?
It does kind of seem like that we are going to go through this seasonal weakness in August. I don't necessarily believe in seasonality in the markets, because if it existed, it wouldn't exist, in the sense that people would trade on it and those patterns would disappear. But I do think that we do have a situation, because of the data, because of the movements or lack of movement by the Fed, we are setting ourselves up for an increase in the volatility, the VIX index, which is typically downside volatility. Volatility in and of itself doesn't have to be bad, especially if it's upside volatility. But this, I think, is where it's more the downside volatility, and it's likely to persist until the Fed does start changing its tune.
Brian, great to get your perspective this morning. Really interesting stuff. Thank you.
Thank you.
That does it for Morning Brief. Much more ahead on Yahoo Finance, including opening bid with executive editor Brian Sozzi. Stay tuned.